Professor, Swiggy's IPO is opening tomorrow in India, and I would love to start with that, given you were so vocal about Zomato's IPO. There's a lot of buzz around the company, and the question on everyone's mind is whether to buy or not. Given Swiggy's current metrics, what would your approach be in assessing its valuation? And are there broader lessons here for retail investors navigating such IPOs?
I'm not sure I was that vocal. I was curious about the Zomato IPO. I wrote about it, but to be quite honest, I haven't thought much about it since. I mean, I'm a dabbler. I tend to think about things that are interesting, then I move on. So Zomato is not the center of my universe. I've never actually used Zomato to order food, partly because I can't do it here. But I think that with Swiggy, I would look at the same determinants. Swiggy is a joint bet on India's growth as a country, because let's face it, without India growing into its income, restaurants will not be able to make money. And without restaurants, you will not get restaurant delivery. So this whole chain of things have to happen. It's a joint bet on India's growth, the propensity of Indians to eat out, which has increased over time, but it'll continue to increase, and what the delivery business will look like in terms of regulation, technology, etc. So when you make those bets, you got to be clear about the bets you're making. This is true not just for Swiggy, but for every company you invest in. Be clear about what you're betting on. And you're not betting just on the company, you're betting on a country, you're betting on a culture changing. And all of those things will play out in what you're willing to pay for Swiggy.
Yeah, absolutely. Any thoughts around the quick commerce business? Because what has happened in the Zomato stock, we've all seen that Blinkit's acquisition for $500 million now has resulted so successfully for them. What thoughts about Swiggy and Instamart?
I'll be quite honest, I'm never quite sure what to make of words that emerge. I'm not sure, for instance, what quick commerce is or last mile is, but I'll give you why I think Zomato has done so much better in the market than I expected. I was in India a couple of months ago, and one of the things I noticed, I was in Chennai, but I'm sure this is true in Mumbai or Delhi, is how incredibly time consuming it is to run even what should have been the quickest errand, something a mile away, something that you'd have driven out to in 5 minutes, picked up your laundry and come back. You're looking at maybe an hour because of the traffic, because of finding parking, and all of the related issues. In many ways, Zomato is arbitraging that logistics problem in India. And Swiggy might be able to as well if they can scale up. The Blinkit acquisition gave them an opening, but I think this is an opening that exists for lots of companies. Here's how it works out. You're an Indian professional. You work all day. You come back from work at 7, 8. Put in whatever time you come back from. You pull into your driveway in your motorcycle, your car, whatever it is. You go up to your living room and say, "Oh my God, I forgot to pick up whatever." And then you think about going out to pick it up, and your stomach drops because you realize that's going to take up the bulk of the rest of your evening. What Zomato is doing is inserting itself in that space, saying, "Hey, you know what? You want your laundry picked up? We'll do it for you." And what it's benefiting from is if you look across Indians, the value that they put on their own time has a huge variation. I'll wager you walk out there, you talk to and you talk to people on the street. There are some people who might value their time at 100 times more than you do, or 100th of what you do. Zomato and Swiggy are taking advantage of is that time arbitrage. And essentially they're saying you value your time at $50. That person values their time at 50 cents. They will do things for you with their time that you would never be willing to. I wouldn't be surprised. It might already be happening. New Avengers movie opens up, or a new movie you want to see opens up. There's a long line to buy tickets. You don't want to go wait in that line because you value your time, for better or worse, at a high number. Zomato says, we'll hire somebody to stand, or Swiggy says, we'll hire somebody to stand in that line for you. You pay us X dollars. It might sound like a lot to pay somebody, but relative to your time. So I think with both Zomato and Swiggy, that's something to factor in, is the infrastructure problems in urban India. India's done a lot in terms of infrastructure outside the urban areas. I like the highway systems. I think it's a big investment that's paid off. But the cities are a complete infrastructure mess, and it's not fixable. It's not fixable with reasonable amounts of money because the city's already been built. You can't, widen the streets without creating chaos. So I think both with Zomato and Swiggy, I would say look past the current numbers. You're not buying the last year's financial statement. There's not much there. For either Zomato or Swiggy, you're buying potential. You're buying the expectation that the infrastructure problem in India is not going to go away and that these companies will be able to leverage themselves up to be the first movers in this business. And the advantage they have is they already have a platform, they already have the people working for them. It's just an extension of, instead of going, asking their drivers to go pick up food from a restaurant, they ask them to go pick up laundry from a laundromat. So it's an extension of their business model. So with Swiggy, I wouldn't be surprised if that gets priced in, even if they're not able to do it. And Blinkit is not the magic that opened it up. It allowed them to do it, but I have a feeling that they'd have got there eventually. Blinkit just speeded up the process.
Yeah, absolutely. Those are very interesting insights. But when you think about these consumer tech businesses at large, what premium would you put on the intangibles such as the brand? Zomato's IPO was a very big signal to the Indian market because of the consumer pull that it's been able to create. And Swiggy has a big cult as well of consumers that really believe in the brand story. And also, there's significant retail participation, which is happening in Indian equities now. How should we value the brand and intangibles?
I don't want to be facetious, but have you ever tried paying for lunch with intangibles or a house with intangibles? Ultimately, for intangibles to have value, they have to show up in the numbers. The reason accountants may have this fixation about intangibles is they're balance sheet focused. And the reality is, and they're right, balance sheets have historically been tilted towards things you can do: land, building, equipment, machinery. So balance sheets have been very poor receptacles for intangibles because accountants have no imagination. I hate to insult accountants. Actually, I do like to insult them, but so I'll act like I hate to insult them. But they don't have the imagination to do it. In intrinsic valuation, the value of a business is driven by its cash flows, the growth in those cash flows, and the risk in those cash flows. That's it. It's true in every business. If you have an intangible and it'll never create cash flows, you know how much it's worth? Absolutely nothing. If you have an intangible that is going to create cash flows, it should be in your intrinsic valuation already. So, when you think about brand name, how does it show up? That when you get on as a customer onto your apps, you're more likely to pick Zomato over another app because it's more reliable. You've used it before, which means it shows up as higher revenues. Maybe you're willing to pay a higher price for food from the same restaurant because you think this app will deliver better than the other app. I'm not sure that's true. But those are the questions that drive the value of intangibles. I mean, I wrote a piece on intangibles a few weeks ago, looking at Nike, one of the legendary intangible companies out there. That swoosh is just one of the best recognized brand pictures of all time. You know how much money they paid to get the swoosh? $35. They were a small business. The designer came in and said, "What about this?" And they actually picked the swoosh accidentally. They paid $35 for it. And my point was, people act like intangibles are something you can plan for, that you spend enough money on it. Intangibles are often the result of a series of accidents along the way that build up to something that you can use now to either generate higher revenues, higher margins, higher cash flows, or reduce your risk. So with every intangible, that's what I force people to do. I'm saying, I'm not telling you intangibles don't have value, but it should be in there. Where is it in there? That's an exercise that's not just an intellectual exercise, but it cuts the heart of investing. Because if you're investing in a brand name company and where it's showing up is higher margins, then you need to, as an investor, keep your eyes on the margins, because if your brand name is dissipating, that's where it's going to show.
Absolutely. And how do you think about the current valuations that these companies are valued at? There is a debate which is going on in India that Swiggy is listing at a significant discount compared to Zomato, given that they're at the same revenue, even though Swiggy is still loss making and Zomato is already profitable. How does one think about that?
Are we talking about relative price? This has nothing to do with valuation, right? It's most of the people making these statements have never fully valued a company. They price companies. They use multiples of revenues, earnings. And when they say Swiggy trades at a discount, they're arguing that it trades at a lower pricing than an otherwise similar company, with similar in quotes. Now, I think that to try to explain pricing differences again, you need to go back to basics. Basics are revenue growth, margins, reinvestment, and risk. So if the pricing difference is coming from a fundamental, and I think there are reasons to believe that Swiggy fundamentally has less attractive features on margins and reinvestment than Zomato does, then you could argue that it should trade at a lower multiple. But let's be very clear, most of the time when people talk about valuation, they're really talking about pricing. And the difference between pricing and valuation is, valuation, you have to understand business. I told you about thinking about the growth of the country. With pricing, you avoid all of those, but at a cost. It's sloppy. It's lazy. You're comparing one company to another and said, this company looks cheap, and both could be overpriced by 50 or 80 or 100%. You're just finding the less overpriced stock. So if you ask me, should Swiggy trade at a lower multiple, I presume, of revenues, because that's the only positive number you have to scale up? It should probably, because Zomato's further advanced in the life cycle, has shown that it can turn the corner from losses to profits, and Swiggy hasn't done that yet.
Would you buy either of the companies?
I'll be quite honest, buying an Indian stock for me is a reach now, and I'll explain why. It's not that I don't buy into the India story. I think the India story is an incredibly powerful one. I do believe the next decade will belong to India if it plays its cards right. But having said all of that, I think the market is underestimating the glitches in the India story, the flaws in the India story, and essentially it's pricing the Indian market as if the India story will be delivered almost effortlessly. So if you look at the pricing of Indian stocks and you look at the risk premium you earn over something risk free, Indian equity risk premiums don't look attractive to me relative to equity risk premiums in Europe or even the US. Now, what does that mean? If I have a choice, and I do as a global investor, and I'm looking at an Indian company competing with a non-Indian company, the fact that Indian stocks collectively have been marked up so much makes it much more difficult to find an undervalued Indian stock. I'm not saying there are no undervalued Indian stocks, but looking for that undervalued Indian stock is going to be much more difficult. You know why Indian investors will not notice it, right? Because you have pricing companies, that's not going to show up, because on a pricing basis, half of all stocks will always look cheap and half will look expensive. It's a relative statement. So I think from that perspective, it's really difficult for me to reach to buy an Indian stock right now because there are so few that pass my radar as